Your money disappeared the moment you deposited it. Not stolen, not lost, just gone. Legally transferred out of your hands and into a system that is no longer required to keep a single dollar of it waiting for you. And right now, in the most secretive regulatory move of the decade, the last safety net protecting what little buffer was left has just been quietly cut. No breaking news, no alert on your phone, no press conference, just a vote, a signature, and a 90-day window that most people will never even know existed. What you are about to hear is not a theory. It is not a prediction. It is documented, verified, and hiding in plain sight in government filings that almost nobody reads. By the time this video ends, you will never look at your bank account the same way again. And that is not a warning. That is simply what happens when the truth finally gets explained in plain language. Welcome back to Global Updates 24, the channel that gives you the news behind the news, the stories that matter before they become headlines. If you are new here, hit that subscribe button right now and turn on notifications so you never miss a critical update like this one. And if you find this video eye-opening, do us a favor. Smash that like button and share this with someone you care about, because this is the kind of information that changes how people protect themselves. Now, let us get into it. Let us start at the very beginning, because to understand why what just happened is so significant, you first need to understand something most people were never taught about how banking actually works. And once you see it, you cannot unsee it. The moment your paycheck lands in your checking account, most people picture their money sitting safely in a vault somewhere, a little digital cubby with their name on it, patient and untouched, waiting for them to make a withdrawal. That mental image feels right, it feels safe, and it is almost completely wrong. Back in March of 2020, with almost no public fanfare, the Federal Reserve made one of the most structurally significant banking decisions in modern American history. They reduced the reserve requirement to zero, not lowered it, not adjusted it, eliminated it entirely. What that means in real practical terms is this: your bank is now under zero legal obligation to keep any portion of your deposit on hand. Not 10%, not 5%, not one single dollar. Zero. So when you deposit your money, the bank does not hold it. It becomes part of a massive rotating pool of capital that the bank can lend out, invest in financial markets, move across borders, and deploy however it chooses. Your account balance is not a stack of cash in a safe. It is a number on a screen, a promise, a claim, an IOU. And the only way you collect on that promise is if enough other people are not trying to collect on theirs at the exact same time. Think about it this way. Imagine you park your car in a garage overnight. You assume it will be exactly where you left it when you come back in the morning. But in this version of the garage, there is no rule requiring them to keep your car on the premises. They are free to rent it out to someone else while you sleep, drive it across the city, lend it to a third party. When you show up the next morning, your car will be there, but only if enough other cars happen to come back before you arrived. Most mornings that works fine, but there is no guarantee. And nobody told you that was the arrangement when you handed over the keys. That is layer one. Your money is not sitting still. It never really was, but now there is not even a minimum floor requiring any of it to stay within reach. And that alone would be worth paying attention to. But then comes layer 2, and this is where things get personal. After the financial collapse of 2008, the public was outraged. Hundreds of billions of taxpayer dollars were funneled into the same banks that had caused the crisis in the first place. The word bailout became toxic, and lawmakers responding to that anger promised the world, never again. No more using public money to save reckless banks. The system was going to be redesigned. And it was, just not in the way most people assumed. What replaced the bailout framework is something called a bail-in. The difference sounds minor. It is not. In a bailout, the government reaches into the taxpayer's pocket to save the bank. In a bail-in, the bank reaches into its own structure to save itself. And that structure includes bondholders, shareholders, and, here is the part that changes everything, depositors, people like you with money in an account. Here is the legal reality that almost no one explains clearly. When you deposit money into a bank, you are not storing property. You are extending a loan. The bank takes your money, gives you a credit on their books, and you become what the law calls an unsecured creditor. That phrase matters enormously because in the event of a bank resolution, a structured collapse, unsecured creditors are the people who stand in line waiting to be made whole after everyone with higher legal priority has already been paid. You are not the bank's customer in that scenario. You are one of its creditors, and not even a senior one. Now, at this point, most people lean on the same response. Okay, but that's why we have FDIC insurance. And it's a fair point. The FDIC, the Federal Deposit Insurance Corporation, has a real track record. Since 1933, every time it has been called upon to protect insured depositors, it has done so. That history matters. But so does the math. And when you look closely at the math, the reassurance gets a lot more complicated. Right now, the FDIC's insurance fund holds approximately $129 billion. That sounds enormous until you realize it is responsible for guaranteeing over $10 trillion in deposits. Run those numbers, and you get roughly $1.17 set aside for every $100 promised. The system is not built to cover everything at once. It is built on the assumption that it will never have to, that bank failures will be isolated, orderly, and spaced out enough for the fund to recover between events. And most of the time, that assumption holds. But in 2023, we got a glimpse of what happens when it does not. When several major regional banks failed in rapid succession, the FDIC had to borrow approximately $93 billion just to cover what it had already promised to depositors. The institution designed to protect your savings had to go into debt to fulfill that protection. The system stretched. It did not break, but it stretched. And that tells you something critical about how thin the margin actually is. So now you have layer 1, no reserve requirements, meaning your money is not required to be there. Layered on top of layer 2, meaning if the bank fails, you are legally a creditor, not a protected customer. Layered on top of layer 3, meaning the insurance backstop operates on a fraction of what it guarantees. But there is a fourth layer, and this one is the one nobody ever explains. It is about the line, specifically where you stand in it. When a bank enters resolution, when regulators step in and start winding things down, there is a legal priority order. Certain obligations get paid first, others wait. And buried inside that hierarchy are financial instruments called derivatives. These are complex contracts banks use to manage risk across massive positions. They sound abstract. The numbers attached to them are anything but. Individual major banks can hold derivative exposures measured in the tens of trillions. Across the entire system, the figure climbs even higher. And under current law, those derivative obligations have settlement priority over deposits. What that means in plain terms, if a systemically significant bank begins to collapse, a wall of financial contracts standing between you and your money gets settled first. You are not at the front of the line. You are not even close to the front of the line. If you think this is purely theoretical, consider what happened in Cyprus in 2013, a modern European nation with a functioning banking system and deposit insurance in place. When its banks hit a crisis point, depositors, especially those holding amounts above insured limits, woke up to find their accounts had been restructured. Their cash had been converted into shares of the failing institutions. ATMs ran dry within days. Banks stayed closed for weeks. Capital controls restricted movement of money for years. More than a decade later, some Cypriot depositors are still trying to recover what they lost. That is not ancient history. That is 2013. That is within the lifetimes of most people watching this video. Now, here is where everything we have just walked through connects directly to what happened in March of 2026. Because against that backdrop, zero reserve requirements, bail-in frameworks, fractional insurance coverage, and a derivative priority hierarchy, the people in charge of regulating the system made a decision to remove more of the buffer. On March 19, 2026, three of the most powerful financial regulatory bodies in the United States, the Federal Reserve, the FDIC, and the Office of the Comptroller of the Currency, voted on a package of changes tied to what is known internationally as the Basel III framework. Basel III was born directly from the lessons of 2008. Its purpose was to require large banks to hold stronger capital cushions, real buffers capable of absorbing losses before those losses cascaded outward to depositors, taxpayers, and the broader economy. For over a decade, those requirements represented the industry's most significant post-crisis safeguard. The latest vote loosened them. Large banks are now permitted to operate with comparatively thinner capital buffers than what Basel III originally demanded. The protections that were deliberately strengthened after the last major crisis have been softened. And this did not happen during a period of financial calm. It happened while interest rates remain elevated, while global markets are recalibrating, while liquidity conditions are among the tightest they have been in years, while analysts inside the banking sector are quietly drawing parallels, not identical, but structural parallels to the conditions that preceded 2007 and 2008. The argument from regulators is that the system has matured, that banks are better positioned, that flexibility is appropriate. And perhaps that is true. But when you place that argument alongside every layer we have just walked through, it becomes part of a consistent pattern. Not one change in isolation, but a series of adjustments, each moving in the same direction. Less immediate protection between instability and impact. And here is the detail that gives all of this an urgency beyond theory. This vote opened a 90-day public comment period on the Federal Register. That means the rule change is not yet finalized. It is in a narrow window, one that most people will never see, never find, and never know existed, where public input is not just permitted, but legally required to be reviewed before the rules become permanent. Once that window closes, this framework stops being a proposal and becomes the new baseline, quietly, permanently. No announcement in plain English. No moment where someone explains what it means for your savings account. It simply becomes the structure the system operates within, and the rest of us adjust to it after the fact, the way we always do. So the question that naturally follows is, what do the people who understand all of this better than anyone do with that knowledge? Because one of the most reliable signals in financial history is not what those closest to the system say publicly. It is what they do privately with their own capital. Over the past year, one of the most scrutinized investors in the world, someone with decades of pattern recognition across multiple market cycles, has been making moves that are difficult to ignore in both scale and timing. Hundreds of millions of shares in major banking institutions sold off, not in a single panic liquidation, but steadily, methodically, across multiple quarters. The proceeds were not immediately redeployed into other high-risk positions. They were accumulated into a massive cash reserve, hundreds of billions of dollars, parked and sitting, waiting. Again, this is not a prediction. Large portfolios make complex decisions for multiple reasons simultaneously. But context cannot be ignored, because at the same time those capital movements were happening, voices inside the banking world itself, analysts, former executives, senior economists, began using language that has not been heard in combination for nearly 2 decades. References to 2007, references to converging indicators, sustained energy price pressure, a strong dollar creating friction for global liquidity, elevated long-term bond yields putting stress on equity valuations. None of these factors alone signals a crisis, but when multiple indicators begin moving together, they can create feedback loops, self-reinforcing pressures that tighten financial conditions in ways that spread across the system faster than most people expect. So when you step back and look at the complete picture, all 4 layers at once, the question is no longer whether the system has risks. Every financial system has risks. The question is whether you are positioned with your eyes open or your eyes closed. The good news is that awareness itself is an action, and there are 3 practical steps that do not require predicting the future or making dramatic decisions, but simply align your behavior with how the system actually works today. The first step is clarity. Use the FDIC's own electronic deposit insurance estimator. It is free, it is on their website, and it lets you map exactly how much of your money is covered and how much is not. Most people assume coverage applies per account. It does not. It is structured per depositor, per institution, within specific ownership categories. That distinction changes the math for a lot of people. The second step is distribution. If you are holding amounts that exceed insured limits at a single institution, spreading those funds across multiple banks or account types is one of the simplest, most direct ways to reduce exposure. No prediction required, just alignment with the rules that already exist. The third step is perspective. Reconsider the assumption that a traditional bank account is automatically and always the safest place for every dollar of your liquidity. There are other instruments and structures, each with their own trade-offs. The key is understanding that safe is not a fixed label. It is a function of how the system surrounding it is structured at any given time. And right now, the structure just shifted. That is what this comes down to. Not panic, not a prediction of collapse, but the recognition that the systems you rely on do not announce every meaningful change in a way that is easy to find. Sometimes the most consequential shifts are the quiet ones, the ones that do not interrupt your day, do not trigger any alert, do not force your attention. They just reshape the environment around you and become the new normal before most people even realized a change was happening. You are in one of those moments right now. A narrow window where something significant has changed, where the public comment period is still open, and where understanding what is happening is still something you can act on. Not after the fact, now. That is the edge. That is what separates the people who navigate these periods and the people who simply absorb the consequences of what they did not see coming. Run the numbers. Check where you stand. Make decisions based on what is actually true about the system, not what you assumed was true. Because in a system that runs entirely on confidence, the people who ask better questions consistently end up in better positions. If this video gave you a clearer picture of what is actually happening inside the financial system, do one thing right now. Share it. Send it to someone in your family, your circle, anyone who has money in a bank and deserves to understand what that actually means in 2026. Every share gets this information in front of someone who needs it. And if you are not subscribed to Global Updates 24 yet, now is the time, because the stories we cover here are exactly the ones that do not make it to the front page until it is already too late to act on them. Hit subscribe, hit the bell, and we will see you in the next one.